security valuation. Under that first concept, valuation of right shares. X rate value. X rate value is nothing but net asset value that equals to net assets divided by number of shares. Value of right equals to X rate value minus offer price. Offer price means right issue price. Value of right per share equals to value of right divided by number of right shares per one share. Next, intrinsic value of the bond. Intrinsic value of the bond equals to present value of future cash inflows discounted at yield of similar bond. That equals to interest into present value annuity factor at the rate of R for n years plus residual value into present value factor at the rate of R for nth year. Another way for calculating intrinsic value of the bond equals to coupon payment divided by yield. If intrinsic value of the bond is greater than current market price, bond is underpriced, purchase it. If the intrinsic value of the bond is less than current market price, bond is overpriced, do not purchase. If intrinsic value of the bond equals to current market price, bond is correctly priced, do nothing. Next, zero coupon bond. Zero coupon bond or deep discount bond are issued at discount. There will be no interest payment. There will be, in case of zero coupon bond or deep discount bond, no coupon payment or no interest payment will be there, but they are redeemed at par. Plain vanilla bond or conventional bond, these are the normal bonds. They get interest regularly, and finally there will be redemption value. Interest is calculated on face value of the bond. That equals to interest equals to face value of the bond into coupon rate. Perpetual bond or irredeemable bond. Interest is always paid. In case of perpetual bond, there will be no redemption. Intrinsic value of the bond equals to coupon payment divided by yield. Current yield equals to YTM in this bond. Non-conventional bond. Non-conventional bond. In case of non-conventional bond, coupon rates are different for different years. Discount rate is inversely proportional to intrinsic value. From bondholder's point of view or debenture holder's point of view, it is called as intrinsic value. From company's point of view, it is called as issue price. Yield. First one, current yield. Current yield. Current yield equals to coupon payment divided by price of the bond into 100. Current yield ignores residual value. Current yield is suitable for perpetual bond or irredeemable bond. YTM, yield to maturity. YTM equals to internal rate of return of the bond. How to calculate YTM? By using the following formula. Future value for n years equals to present value into 1 plus R whole to the power n. Future value for n years equals to, that means the face value of the bond. Present value means market price of the bond. R means YTM. N means life of the bond. A second way for calculating the YTM is trial and error method. That means interpolation technique is used. In YTM, intermediate cash flows are reinvested at IRR, internal rate of return. In perpetual bond, current yield equals to YTM. How to calculate approximate YTM? For conventional bonds or plain vanilla bonds, approximate YTM equals to capital A into 1 minus T plus RV minus MP divided by N whole divided by RV plus MP divided by 2 into 100. To calculate accurate YTM, we need to follow trial and error method. To calculate approximate YTM, we can use this formula. Next, post-tax redemption value equals to redemption value minus capital gain tax. We will get post-tax redemption value. 1% equals to 100 basis points. Next, face value of bonds or debentures is 100. Face value of equity shares is 1. Face value of preference shares is 100. If the question is silent, we need to follow these values. For bonds, debentures, equity shares, preference shares. For equity shares, it is 100. For bonds, debentures, preference shares, the face value will be 100. For equity shares, it is 10. For bonds, debentures, preference shares, it is 100. Next, bond risk. Rate or yield is inversely proportional to bond price, bond market price. Duration. There are 4 types of durations. Normal duration, effective duration, maculous duration, modified duration. First, how to calculate normal duration? That means duration equals to current yield divided by YTM into present value annuity factor at the rate of YTM for n years into 1 plus YTM whole plus 1 minus current yield divided by YTM into N. Next, effective duration. How to calculate effective duration? Effective duration equals to higher price minus lower price divided by 2 into current market price into change in yield. That is P2 minus P1 divided by 2P0 into change in YTM. It is nothing but change in bond price divided by change in YTM by 1%. Next, macro's duration and modified duration. For calculating macro's duration and modified duration, following is the format. Year, cash flows, YTM, present value, year into present value. We need to calculate the total of fourth column, that is present value, and year into present value, that is fifth column. Total of present value is called as current market price. Macro's duration. Macro's duration is nothing but average due date, calculation of average due date. It is always expressed in years. Macro's duration equals to summation of year into present value divided by summation of present value. Modified duration, that is volatility. Modified duration equals to duration divided by 1 plus YTM. Yield ratio equals to current yield divided by YTM. Next, present value of future cash flows equals to future value for n years divided by 1 plus R whole to the power n. Future value of present cash flows equals to present value into 1 plus R whole to the power n. Present value of perpetual cash flows equals to cash flow per annum divided by required rate of return. Present value of perpetual bond equals to interest per annum or coupon per annum divided by KD or YTM. Return equals to coupon plus or minus capital gain or loss. In case of deep discount bonds, present value equals to future value for n years divided by 1 plus R whole to the power n. Floating rate bonds are always valued at par. If question is silent, market rate equals to yield rate. How to calculate approximate YTM? Capital A into 1 minus T plus RV minus MP divided by N whole divided by RV plus MP divided by 2. Or follow IRR method for calculating accurate YTM. Price. Bond price is inversely proportional to yield or YTM. YTM assumes reinvestment. That is, YTM assumes intermediate cash flows are reinvested at IRR. What is CAGR? CAGR means capital appreciation growth rate. There are 4 types of rates in bond market: coupon, YTM, reinvestment rate, realized YTM. Duration is principal holding period or principal payback period. Duration is the average period the money is blocked in a bond market. It is the optimum holding period. It is the base to calculate volatility. How to calculate volatility or modified duration? Modified duration equals to, or volatility equals to, duration divided by 1 plus YTM. When only 1 year cash flows exist, present value equals to future value divided by 1 plus R whole to the power n. When more than 1 year cash flows exist, present value for second year equals to cash flow for first year divided by 1 plus R1 plus cash flow for second year divided by 1 plus R2 into 1 plus R1. Present value for third year equals to cash flow for first year divided by 1 plus R1 plus cash flow for second year divided by 1 plus R2 into 1 plus R1 plus cash flow for third year divided by 1 plus R3 into 1 plus R2 plus into 1 plus R1. F2. Ft equals to 1 plus R1 divided by 1 plus R2 square minus 1. F3 equals to 1 plus R3 whole cube divided by 1 plus R1 into 1 plus R2 minus 1. Bond immunization. To have the effect of immunization, one should invest in such a bond where duration is equals to time horizon. If yield does not change throughout the life, reinvestment will be made at YTM. Yield will be affected by duration. Flotation cost. Flotation cost is an asset in the balance sheet. 3 steps involved is summation of T into T plus 1 into discounted cash flows for T years. Second step, step 1 divided by price divided by 1 plus Y square, 1 plus Y whole square, 1 plus Y whole square. Third step, volatility into change in YTM plus half into convexity into change in M square. Next, decision making in case of convertible debentures or bonds. Conversion value or stock value of the bond equals to conversion ratio into market price per equity share. Conversion premium. It is always expressed in rupees. Conversion premium in rupees equals to market price of the bond less conversion value. Conversion premium in rupees per equity share equals to market price of the bond less conversion value divided by conversion ratio. conversion premium in percentage, that is ratio of conversion premium equals to market price of the bond less conversion value whole divided by conversion value into 100. Conversion parity price or market conversion price, that equals to market price of the bond divided by conversion ratio. This indicates that if price of equity shares increases to conversion parity price from current market price, how much it is increasing, the investor will neither gain nor loss on buying the bond and exercising it. Favorable income differential per share, coupon interest from the bond minus conversion ratio into DPS divided by conversion ratio. Premium payback period. Premium payback period equals to conversion premium per share divided by favorable income differential per share. Straight value of the bond equals to present value of future cash flows from bond by using without conversion option interest rate. Percentage of downside risk equals to market price of the bond less straight value of the bond divided by market price of the bond into 100. Premium over straight value equals to market price of the bond less straight value of the bond whole divided by straight value of the bond into 100. Conversion ratio equals to number of equity shares on conversion of bond. Next concept, bond refunding. Bond refunding. In case of bond refunding, there are 3 steps. First step, identify all cash flows arising on date of replacement during the life of the bond and date of maturity. Calculate present value of cash flows. Decide whether bond refunding is beneficial or not. First one, initial cash outflows or investment. Call or redemption premium less tax savings gives flotation cost of the new bond. Less tax savings on unamortized discounting and flotation cost of the old bond. Next, overlapping interest on old bond less tax savings. We will get the initial outflow, cash outflow or investment. Annual cost of old bond. Interest on old bond less tax savings. Less tax savings on discount of old bond, that is discount of maturity period, discount divided by maturity period into tax rate, discount divided by maturity period into tax rate. Less tax savings on flotation cost of the old bond, that equals to flotation cost divided by maturity period into tax rate. We will get annual cost of old bond. Next, annual cost of new bond. Interest on new bond less tax savings minus tax savings on discount of new bond. How to calculate it? Discount divided by maturity period into tax rate minus interest tax savings on flotation cost of the new bond, that equals to flotation cost divided by maturity period into tax rate. We will get the annual cost of new bond. Annual savings equals to annual cost of old bond minus annual cost of new bond. Present value of annual savings equals to annual savings present value annuity factor at the rate of R for T years. Rate for discounting will be after tax cost of debt. If not given in the question, use after tax interest rate of new bond for discounting. Calculate NPV, present value of annual savings less initial cash outflow or investment. We will get the NPV. If it is positive, bond refunding is beneficial. If it is negative, bond refunding is not beneficial. Next concept, immunization of the bond. When YTM changes, there will be 2 types of risks on bond: price risk and reinvestment risk. For immunization of the bond, we select maximum 2 bonds for investments in such a manner that both above 2 risks, price risk and reinvestment risk, shall offset each other. For selection of 2 bonds, use following equation. Required duration equals to duration of A into weight of A plus duration of B into weight of B plus weight A plus weight B, so on, equals to 1. YTM is inversely proportional to bond price. Valuation of warrants. Warrants value equals to market price of equity shares less excess price of the warrant into number of equity shares convertible with 1 warrant. Change in bond price equals to percentage change in interest into minus modified duration. Portfolio duration. Duration of portfolio equals to weight of A into duration of A plus weight of B into duration of B, so on. Weight of N, duration of N. If coupon rate equals to discount rate, bond price is at face value. If interest rate decreases, buy longer duration bonds. if interest rate decreases, buy longer duration bonds. If interest rate increases, buy shorter duration bonds. If duration increases, risk will be high, buy less riskier bonds.